Welcome to Power Charting. I'm your host, Bruce Fraser. We are going to continue our chart reading the Wyckoff way, our Tesla case study, part 2. Last week, we talked about Tesla. We did an in-depth Wyckoffian view of the weekly chart on Tesla over a time period so that you could see demonstrated how Wyckoff analysis views chart studies. And this week we are going to continue that discussion, looking at some other time segments and point and figure charts. And we have the incredible Roman Bogomazov with us to do that. Roman, thank you for being here.
Well, Bruce, thank you so much and glad to be here.
So we left off at this chart right here and did a complete analysis of this whole area, starting with a buying climax in 2017. So, Roman, we had ended at the point where we were discussing the right side of the chart and whether or not there was enough cause built to be able to proceed upward. And I guess the one comment I would have about that is we may have causal accumulation that is off the left side of the chart that we can't see here that would point to higher prices for Tesla that literally would allow the stock to not build a new accumulation base before it starts to rally again. Does that make sense? So the cause might precede where we are, and here's a point and figure chart to demonstrate that. So now keep in mind that these charts are adjusted for a 15-to-1 stock split in Tesla. It's split 5-for-1 and 3-for-1. And so here we have done a modified point and figure chart. It's 5-box reversal method. Not going to get into that today, but think of 5 boxes a little bit like looking at a monthly chart. So 5 box covers a lot of time and a lot of data, and it's half-point scaling. So we can see 2 structures here which have been defined with those shaded areas. And Roman, your thoughts on this chart before we move on or dig in?
Yeah, well, I guess I have questions, Bruce. So I mean, my question here is, how could we, why are we using, two boxes here, identifying that cause, and they seem to go into the same target? How would you explain this?
Well, in fact, we would call these, I would think of the yellow shaded area as an accumulation structure. Definitely has the look of that. And the area on the right, which is what we just analyzed on the weekly bar chart, has the look of a reaccumulation structure that happens after a rally of sorts, which we just evaluated. Now note how deeply the reaccumulation corrects down into the prior structure, but it's its own unique structure because it does not overlap the entire prior move and go lower. It makes a higher low. So it does not, if it was to go to a lower low, it would effectively negate the count on the left. And so again, topic for another day in point and figure, just so you know the ground rules. But notice this, the accumulation structure counts up from a low of around $9.50 in account line there at 16.5, counts up to $57 to $64. And we are taking this larger count on the right. This counts from the low, and it counts back to this area, which is a very deep correction at this where the 21 is and the number 4. And note that that very deep decline there, which is like a shakeout, rallies all the way back up near the prior highs. So that does set a trading range. And that is that's where we would define the segment that we want to count to. That's 21 columns. That counts from the low and from the count line at $14.50 counts up to 64.50 to 66. The accumulation base count and the reaccumulation count approximately equal each other. It's a stepping stone confirming count. These are very, very effective. And what this does is it gives us a timing tool, because when the reaccumulation count approximately equals the accumulation count that's lower, that's often when the new rally starts. So that's a lot to digest on this chart at one time, but those are effectively the ground rules.
Mm-hmm. Let me give you guys a shortcut to the change of behavior and to the change into the new environment. So we usually say like, okay, we want to have some kind of local change of behavior, followed by testing, and then followed by local breakout, which acts as a confirmation. So at that point, you know that from, let's say, a downtrend, we are switching into the uptrend, or let's say from the trading range, we're switching to like uptrending environment and so on and so forth. And on this chart, you could see in both of the areas at the end of the both trading ranges, exactly that is happening. So for instance, this column right here represents a change of behavior. Why? How come? Well, look at the number of axes here, number of boxes, the extension of the column itself. So this is a cumulative move. There might be some kind of smaller move because this is the reversal 5. Smaller moves, smaller reactions, but there were no reactions that were, let's say, more than 5 boxes of $0.50 each. And this column is larger than this column, or this column right here, or this column, or this column, or this column, or this column. So all of the prior up columns definitely were smaller. So something else is going on here. And what is going on? Well, buying, more aggressive buying. And then after the change of behavior, we want to have the test, right? So here is our test. And it takes 3 columns, and we kind of seeing how from this column right here to the next column of zeros, which is the reactionary column, we're seeing decrease of selling, less selling. And this is exactly what we want to see on the test. And we want to also have some kind of spacing between the low or the lowest low and the low of the test. So also shows us some strength. And then the last third step is just to identify that local breakout. Now you could do this in 2 ways. You could have an downsloping resistance, and here is your breakout number 1. And here is your second breakout number 2. So you have 2 confirmations that now we're switching from the trending range environment into the uptrending environment. The same in the second trading range. Look at this column right here, and then compare it to this, and this, right? So this is the beginning of the move with the lower highs, lower lows into the shakeout action. This is different. This shows more buying. And as the first requirement is satisfied, then we go into the test. The test is very rapid. And it definitely less than, let's say, the last leg down or the leg down before. And we're seeing that the test is also at the significantly higher low. There's a lot of spacing in between the low of the shakeout and the test itself. Okay, last one, and that is our local breakout. Downsloping breakout number 1. So here's your first confirmation. And then you could use the high of the previous rally as your confirmation number 2. So they're pretty close together. And the same sequence of events is suggestive that now from a non-trending environment, we are going to go into a trending environment, in this case, in the uptrend. And Bruce, such a simple technique, just based on the structure, just based on the main Wyckoff ideas of the behavioral change of testing, and then on the idea of the confirmation, you could literally put this into the system using the PNF charts and just do that, and that should be making you really good. That should produce really good trades for you.
I know many people that do that, and they just trade off their point and figure charts. Thing about point and figure is it gives you the essence of the important things that are happening with price, and you can see those very effectively. Even something as big as a 5-box reversal methodology, you can see where the essential breakouts are occurring, when you're getting important higher lows above climaxes, and then these key reversals with immense strength in them. So a
But
beautiful
there is one
description.
problem with this strategy, Bruce. You know what that is?
Tell me.
And that is a human element. Because as many students as we've taught, we constantly hear from students, well, I don't want to buy something at $18 when it was at 12. I don't feel psychologically that I'm buying close to the bottom, so my risk is increasing. Well, first of all, your risk profile will depend and will show it on the vertical daily charts where you would be entering just based on some local structure and not on like a 5-point reversal, 5-box reversal type of structure. That's number one. Secondly, if you have this type of thinking where you're thinking more about catching the bottom, this means that there is some kind of fear on missing out. And you should really address this. You should go and journal about this. You should develop the awareness about why you think this way and why you're not thinking more in terms of like, at 18, I have a high probability trade that, let's say, in 75, 80% of the chances will work out. Whereas at the bottom, I'm probably here the best at 50-50 in terms of the bias risk. And the bias risk is a really, really kind of like serious consideration for us as traders, not just the risk profile between the point of entry and the stop loss itself. So something to think about, and something that we definitely talk to our students a lot.
Well, and let's keep in mind that the essence of Wyckoff is identifying when accumulation is very close to its conclusion, which results in markup. And the markup after accumulation is where all the action is. And Richard Wyckoff would brace his students for the idea that when a market is ready to mark up in earnest, it's going to mark up quickly. Prices are going to move up effortlessly, and we have to be able to steel ourselves to identify this market is ready to go, and I'm going to have to pay up to get on this very young new uptrend, this new markup phase. And there's ways to do it. You know, there's rules in Wyckoff for accomplishing that. Too much for today, but what Ramon's talking about here is absolutely essential, because we have to develop a mindset for the context of where we are in the chart structure.
All right. Well, now that we identified, Bruce, the changes of behavior on the larger structure, on the weekly structure, we've looked at the potential, the causality of it. Now let's talk about tactics. I mean, like, where would we actually enter this trade? So here is our selling climax, automatic rally that we've seen on the weekly chart. And then we have an interesting bar that takes us down with the gap. So maybe some catalyst right there. And that establishes a much smaller structure, a trading range right here. So what would be, in your opinion, the area of where we would start considering entering this position?
Well, let me just point out that we talked about the need for building a cause, and we in fact got a cause. And that started with the June low selling climax, and then an automatic rally, which has great persistency of uptrend in it. And then it goes into a continuation of the causal building process, which almost could be described as a reaccumulation, because look how far off the selling climax low this structure occurs. And we talked about the idea of how volatility comes out of an accumulation structure as you get deeper and deeper in it. You can definitely see that unfolding here, because look at the reaction that we get off the automatic rally peak. We get a reaction down to the August low, which goes nowhere near the early June low, and it goes down. The volume is definitely becoming dull and quiet. You have a lot of volume that comes in at the final low there with that tiny little sort of climactic conclusion, and then it goes sideways into the end of August, has a test. It's like a minor spring of that prior low, and then it rallies back up again. But look at how dull and quiet it is, and then right at the end in late September, it attempts to shake out holders of the stock with a big break, but to a higher low. And so, and then an attempt to rally, and then the next pullback in early October is another higher low. So what I'm seeing here, Roman, is I'm seeing volatility diminishing throughout. And it looks to me like this is evidence of accumulation all the way from June all the way into late October.
Right. We definitely have the oversold condition into that selling climax. And we are testing, as Bruce has said, at the higher ground. So the initial gap down on this increased volume signature was suggestive that maybe we're going to continue with the downtrend. But one very important structural thing that happens during testing, there is no downward follow through. So the price does not go down anymore. And that in itself is a change of behavior. And then throughout this whole, small structure, as Bruce has mentioned a couple of times already, we're seeing diminishing thrust to the downside that diminishes the result to the downside. And look how selling is decreasing from the gap down bar to the attempts to go down. Quite significant. I mean, like that is minus 50% in selling. Next time we are trying to produce the same type of aggression to the downside, again, selling diminishes by probably the same, kind of like minus 50% or so, close to that. And then last time we are trying to do so, we're increasing the effort to push the price down, and yet we're creating the higher low here. And the spread is diminishing, and there is some smaller demand tail. So I would be thinking that overcoming this condition right here would be for us a point of entry in itself. Now, ironically, I was looking at Tesla during this period. Ironically, I've actually entered this position right here. So now here's my post analysis, which is going to be really painful, because as this bar has happened, I kind of like, freaked out and closed the position. And then obviously, withdrew emotionally, which was a big, huge mistake for me at that point of time. What was it, 2018, 2017? I think 2019. Yeah. And, I've been in agony since then as, I saw how the price started to gap up. So the moral of this is, of the story is that do not withdraw emotionally from your mistakes. So I made a mistake. What I should have done is continue monitoring and analyzing Tesla as I've been analyzing it for months prior to this point of entry. And then find other points of entry. So I would say, Bruce, this is a really good area for me, in terms of how consistent buying is and how, especially after this bar, we are actually going up. We're overcoming the intermediate resistance right here. I would say that even the gap bar in itself also favorable at the close into the end of the session. I also like how there is no testing, immediate testing after this gap bar. Usually we would have some kind of test. Here, we are actually extending up, showing that there is continuous buying after that. And what do we see as a test to this two combination of two significant bars? We're seeing a reaccumulation that we would call T1 as the test, which is extremely favorable, showing us that the test happens in the upper part of these two combo bars. I also like the tests that have a slightly higher high and higher low in the structure. It shows another element of strength. And all of that, and well, I want to ask Bruce, is being confirmed by the relative strength. But just one last thought here on the actual kind of like point of entry around this area right here. What else was so indicative that, Tesla is gonna go up and Tesla might outperform? Look at what the market is doing relative to the previous low in Tesla. We are definitely downsloping, whereas here we are upsloping. Again, element of strength. And the market was showing a point of entry on its own. So you are entitled here to come in and open the position just based on what the market is doing and based on how the stock is much, much stronger. So, Bruce, what about the relative strength? I mean, do we have any type of confirmations on the relative strength that, yes, now we're going to go up?
Yes, we do. And we, as we talked about on the prior chart, now we're looking at daily data, but the concepts are the same. We can see a sideways relative strength characteristic to Tesla against the S&P 500, but an upward bias against its peer group, the auto manufacturers. So that is a positive backdrop. But where things get really interesting for Tesla is in September when you have that big down bar that goes to a higher low. That is often referred to as a last point of support. And last points of support are very difficult for traders because they've been patiently waiting so long to get the stock going again. And in many cases, traders will give up on the last point of support. And that's not a criticism of Vermont, but
It should be.
but that is the psychological effect of it, and
Mhm.
it is a very big moment psychologically in the structure of the chart. Then it just starts to cascade higher, and the relative strength is now above a rising moving average, and it's trending upward. This is going to catch the attention of the very large institutional interests because they only want to own these stocks, period. And so remember how we talked about once accumulation is complete, the stock moves up quickly, easily, and doesn't need a lot of volume to do it. But in this case, look at that gigantic gap that Ramon pointed to, and then it pauses and then just keeps going. That is a confirmation that the markup up trending structure is beginning. And here it is, it's in the low 20s at this point when it gets up there. But we have a point and figure count, two of them, that go up above $60. So we always need to keep in mind the potential of our count structures that precede this, because this is what gives us the wherewithal to be able to say, okay, it's a good reward risk characteristic to pay in the low 20s for a stock that has the potential to get into the 60s.
Last thought here, because there is a second point of entry right here that is so visible. So if this was the first area, and I would say even more than that, point of entry number one, this is a point of entry number two. Look at how supply is coming in, and then look at how on this bar that we have a gap here to the downside, but selling is diminishing, result is diminishing as well. And then during testing, look at the level of supply. There is no supply. And that just tells you like come in, come in, come in. And if you're a little bit late, come in on the breakout bar where demand is starting to increase. And you should be fully in this position and even oversized at that point. Why would you be oversized? Based on the idea that this is strength, based on the idea of the continuation to 65. And then look what happens afterwards. Such a beautiful run up into the climactic action. I think the idea here or the conversation should be more about how do I actually stay in this position until the actual climactic action. Bruce, what would be your approach to that?
Well, a classic acceleration. We get acceleration into the end of this really dynamic markup phase, and it just starts to really accelerate with very high volume. Then you can see the beginning of February that there's a higher bar. It's alone up there like an island, and closes off the extreme highs, has a reaction to a slightly higher low from the prior bar, and then it goes up for a secondary test. And the volume on the secondary test is diminishing as it goes up there. Clearly that all that volume on the climax bars, much of it is supply, and it was a place where large interests were selling, and that bar, Ramon, got within 10 cents of our count structure that we took prior with the point figure, within
Amazing.
10 cents.
Yeah, amazing. The question that we usually get is how do you see the climactic action? Well, usually is going to be a acceleration behind the speculation of the price, and that would be an increased upward spread, which increases a lot, gaps up. Then you would have the volume signature that would increase substantially, at least by the factor of 2 or more. And here we see exactly that. And we've seen those spreads and the gaps and so on and so forth. So especially if you're an options trader and you trade in this swing, let's say like you opened the position somewhere here, you have to close it on these 2 bars, either on the first one or the second one, preferably on the second one. And then after that, I mean, like a very quick distributional formation, but we're going into the COVID here, and this is another case study, which also could be extremely interesting. The only other thing, Bruce, that I would add is that, with the price, I see some kind of like, slight deterioration in the relative strength, and that could give you another clue that something is going on. Plus, on the comparative basis, the market was making higher high and the stock was making a lower high. So it was the time to get out.
Perfect. And with that, Ramon, we're done. Tell us more about the Wyckoff market discussion. We do these Wednesdays. We talk about these very things that we're talking about here, but with live current markets. And we would love for you to become a member of our Wyckoff community. Ramon does a series of classes which are like the classes that we did at Golden Gate University. They're exceptional. He's just added so much to it, and this is the way to get to your mastery path in Wyckoff. And with that, Ramon, final words, and then we'll sign off.
Well, thank you guys so much for watching this episode. It was a lot of fun to go through this case study, and I'm looking forward to other case studies as well.
Terrific. And thank you so much, Ramon, and we'll see you all next time.